Hi, I'm Pattu from freefincal. This is a recording of a talk that I gave to the Tamil Nadu Investor Association, their bi-monthly meets on March 24th, 2024. So this is some data on active versus passive investing. And I'll try to split this into two parts or make it into two videos, and let's see how that goes. So I like to start by saying that active or passive investing is a choice. And what is more important is to have a proper financial plan that is suited for your long term needs and short term needs. After that, what you choose is up to you. So, the first step is to have that financial plan. After that, active or passive investing is a choice. It's always best to assume that whatever you are choosing is uh, not really the best choice. It is a choice. And as long as you are convinced that that choice is suitable for your needs, I think you can go ahead. It doesn't matter whether you choose active or passive investing. What I'm showing is the data. So this is the evolution of a fund, some fund. So in the talk, I have not mentioned any funds or AMC names because that is the policy of the Tamil Nadu Investor Association. So this is some active fund uh, versus the Nifty 50. If I'm not wrong, this is the HDFC Top 100 fund. And if you look at an evolution like this, uh, it looks like the fund manager has done a very good job in outperforming the index. But we need to look a little bit closer, because when you look at a graph like this, all you're seeing is actually one return data point. You're seeing the return from this point to that point, from the end to end. So that's just one return that you're seeing, and that is most always misleading. Instead of looking at one return, we should look at what is known as rolling returns. So what we do is we take the chunk of data and split it into return windows, 5 years, 10 years, or any duration, for example, 10 years. So from 3rd April 2006 to 31st March 2016 is one 10-year window. And the return is in that period is 12.12%. And you take that 10-year window and shift it by one day. So from 3rd April, you go to 4th April 2006 to 1st April 2016. The return is 12.08%. And you keep shifting, and you calculate the return over every possible window, and that's called a rolling return. So when you plot this data for the active fund, that is the HDFC Top 200 fund and Nifty 100, Nifty 50 TRI, you can see that the active fund has not consistently outperformed the Nifty 50. In fact, there are 1958 data points, and the fund has outperformed the index for 12,030 return windows. So if you can compute a 10-year rolling return outperformance consistency, you will take this number of times the fund has bet the index 1230 divided by 1958, that is 63%, and we will call this as performance consistency. So this is the metric we are going to use to evaluate the performance of active funds, and we're going to ask how consistently they have bet the index. Sorry. Now, our data is actually, our market history is quite short. If I take 15-year rolling SIP returns, that is, instead of taking lump sum returns, so what you see here in the previous graph is just basically a point-to-point lump sum return, right? But instead of that, I can also do a rolling SIP return. So from every 10-year window or 15-year window, I can actually compute a SIP return instead of a lump sum return. And we don't have enough data for in the Indian stock market, but we have like 1,333 15-year windows for the S&P 500, and you can see the returns move up and down. And if you ask me, I'm going to invest for 15 years in some index, and what is the return? The answer is I don't know. The honest answer is I don't know. People give you all sorts of responses for this. They will say economy is growing, Indian economy is growing, then you have to add GDP growth rate with inflation, this and that, and give you all kinds of sort of thumb rules. But the honest answer is I don't know. There is absolutely no evidence that long-term investing in equity will always work. However, there is evidence that long-term investing in equity offers you a reasonable chance of beating inflation, not matching your expectations. It reasonable chance of beating inflation. That is inflation as decided by the government, not your personal inflation, not your personal return expectation. So you may expect 15% from equity, but that doesn't mean you are going to get it. If you get only 10% after 15 years, that 10% may have bet inflation, but it has still fallen short of your expectation, and therefore that long-term investment has failed for you because you would have invested less expecting 15%. So that is why I keep telling people, don't expect returns. Don't assume all your long-term investments will always work. You must have a proper financial plan. You must have an asset allocation that is able to handle these kind of return variations. You must be able to systematically de-risk the portfolio. Well, very few people listen, but that's I just keep saying nonetheless. So this is the corresponding data for the Sensex. There are only 359 or maybe 360 15-year data points. And you can add about 2% for dividends because this is only the price data. The Sensex TRI data is even a shorter period only is available. Again, you can see that it keeps going up and down. You can't compute an average. One of the biggest mistake people do is when they look at rolling returns, SIP or lump sum, people compute the average. You cannot compute the average just because you have a data set. Knowing what is, I mean, if somebody says, I know the formula for computing average, that's just knowledge. Wisdom is understanding when not to use it. You should know when not to compute the average. You shouldn't compute average for rolling returns. It is not a Bell distribution or a normal distribution. And the average makes absolutely no sense. So you shouldn't compute it. And the answer is, what return can I expect over 15 years is I don't know. And the honest answer is I don't know. You can expect something reasonably small, but there's no guarantee that it will be matched. So we're going to analyze active funds and compare them with category benchmarks. So these are the category benchmarks we use in our monthly fund screeners. So you can pause them and take a look and explain some of these down the line. So now I'm going to talk about overall performance, and we're going to take 10-year periods, every possible 10-year periods using regular plans because you can't get much data with direct plans. So if I take every possible 10-year periods, regular plan funds versus category benchmarks, there are 168 funds across all categories with at least 500 10-year rolling return data points. Out of this, only 78 funds or 46% has a performance consistency of 70% or more. 87 funds have a performance consistency of 60% or more. So that's about only about 45 to 50% have consistently outperformed the index across all categories over 10 years. Over 5-year periods, now you can use direct plans. There are 277 funds, again with 500 return data points is the minimum criterion, because if you have two less, then the history is also less. Only about 35% to 45% of the funds have a rolling return consistency of 60 to 70%. So that's again very, very poor performance. 10 years or 5 years, whatever you take, is a very poor performance across all categories. Now, if you look at mid-cap funds, over 5-year periods, only 18% have rolling return consistency of 70% or more. 32% of the funds have got consistency of 60% or more. So out of 22 funds, only 4 to 7 funds have done well over 5 years. Over 10-year periods, only about 5 to 7 funds out of 14, that's about roughly half, have done consistently well. That is, they have consistently bet the Nifty mid cap total return index. That is for mid. With respect to mid cap, many people say, oh, the fund manager can easily create alpha. They can easily beat the market in the mid cap segment and small cap segment and so on. That's not true for the mid cap segment. Now, coming to the small cap segment, it is extremely easy for an actively managed small cap mutual fund to consistently beat the small cap index. I mean, the small cap index consists of 250 stocks. Most of them are, basically, most of them are junk stocks. We don't know whether they're how some of them are, gone bad. They may go bad. Whatever it is, most of them are not really good. You can't bet your money on them. I mean, if there is a fund manager who is qualified to, has got, let's say, a BTech from some reputed institute, after that an MBA, and after that a CFA, and then he or she goes on to become a fund manager, they better be good enough to pick a few stocks from such a flimsy index, such as a small cap index, and beat it. So beating the small cap index is extremely easy. And saying that an actively managed small cap fund has bet the small cap index is like, it's like saying this, the sun is hot. It's trivial. It's a given. They better beat it for the kind of expense ratio they're charging. However, if you compare the performance of a actively managed small cap fund with a mid cap index, then only half, about 50% of the small cap funds are able to consistently beat the mid cap index. Many people say, oh, how can you compare an actively managed small cap fund with the mid cap index? Look, I am not here to do a PhD. I am not here to publish a research paper. I am here to find out what is the best bang for my buck. I am paying money. I am investing my hard earned money, and you are taking a big chunk of that daily as expense ratio. And therefore, I want to find out what is the best bang for my buck. And I can see that Nifty mid cap index funds at a much lower expense ratio are able to happily beat the actively managed small cap funds or actively managed mid cap funds. So why should I care about actively managed mid and small cap funds? So it makes no sense. So this is the total expense ratio distribution of, you can see here, these are the small caps, the actively managed small caps. These are the actively managed mid caps. These are the index small caps, and these are the index mid caps. You can see that the index mid caps are, at a low cost, are able to beat half the funds in the actively managed mid cap and small cap segment. So why would I choose anything else? I mean, with respect to this, I'm not saying go and buy a mid cap index. I'm saying with respect to this, the mid cap index seems the better choice in terms of returns and obviously in terms of fees. We'll come to choosing the index in the second part of the talk. Now, people say, what about flexi cap funds? The situation with flexi cap funds is essentially the same. Again, only 45 to 50% have consistent, outperformance over 5 years, 55 to 60% over 10 years, only about half. If I'm being very generous, I would say 50 to 60% of the active funds in any category is able to consistently beat a representative benchmark, whether it is flexi cap funds or whether it is focused funds. Of course, there are some issues here with respect to fund history, because fund history in India is extremely short, because they keep changing, rules change, regulators keep changing the rule, fund managers change, fund styles changes, asset allocation changes. It's very difficult to do any rigorous piece of history. So if you are going to complain that, oh, these funds were not focus funds or flexi cap funds 5 years ago, they have changed the investment strategy, you should not be comparing and so on. From an academic point of view, it is reasonably valid. But then you must also admit that there is no real data to say that actively managed funds have outperformed the index. Whether they have whatever strategy they are using, they have always charged hefty fees, and so they better give me my return. They must beat some no reasonably representative benchmark, and that has not been the case. So these are the takeaways. Again, like I said, 45 to 55, maybe 60% of the funds only across any category has bet the index consistently. Selecting those funds, people say, "Oh, if you say only 5 funds have done well, tell me those 5 funds." No, there's no point, because that's based on past data. You can't invest in those 5 funds assuming the next 10 years or the next 15 years will be exactly a replica of the past. That's not going to happen. It's not a guarantee of future performance. So investors are better off with passive funds. There is no fund manager risk, less fee, no performance anxiety. You can spend your time elsewhere doing, spending time with your family, working on your hobbies instead of wasting time on social media or worrying about fund performance. So you should also ask, if you are investing in direct equity, can your direct equity portfolio consistently beat the index? Again, that will be a problem. If you actually take your direct equity portfolio and check carefully, we have the tools to check that. You should, it may give you a surprise. So it may have bet the index, but it may also not have. And so that is something that you should be brave enough to check. Of course, I'm not saying don't invest in direct equity, because many people invest in direct equity because they like it. That's absolutely fine. I'm just saying, don't invest in direct equity with the hope that it will be easier to beat the index or easier to beat mutual funds. That may not be the case. Another uh, opinion is that many people say, oh, this is a recent development. This is a passing fad. This poor performance of active mutual funds. That is not true. If I consider 10-year durations from April 2006 to April 2017, then again, out of 80 funds, only 44 funds have consistently managed to beat the indices. If I consider the period from April 2006 to March 2020, then only 37 funds out of 83 have got a rolling return performance consistency of 70% or more. So this is not a recent phenomenon. It's not something that's happened over the last 2 years, 3 years, 4 years. Even up to 2017, if you checked, it has been the same situation. And passive funds have grown quite a bit. So from March 2020 to February 2023, the number of schemes have changed from 32 to 203. That's a 534% increase in the number of passive funds. The number of folios have increased by 1,226%. And the AUM has increased. I'm sorry, that is part of it is missing, but the AUM growth has been 2,493%. We have excluded the if I exclude the EPF AUM, so of course this includes the capital gains and the EPF AUM. Of course, the EPF has put in the chunk of money in the SBI Nifty 50 and UTI Nifty 50. Including that, unfortunately, I have to include that. That is about 2,493. So, but the passive AUM itself is not much in the what should I say? The market share is not that much. I hope I have not messed that up. I kind of got confused. I mean, haven't looked at that slide for a while. So what I should say is, although there has been a growth, even if you include the EPF AUM, the number of funds that have increased and the folio growth, you can say that the interest in passive funds have increased. And the other point is, although there is an increase, if you exclude the EPF AUM, the passive AUM is about 8% of the total equity mutual fund AUM. 12 years ago, it was 2%. Today, from 2% to it has grown to 8%. That is a big chunk, but it is still only 8%. Out of the active total equity mutual fund AUM, include most of which is active mutual funds, it is only 8% passive. So you must understand that most investors still choose actively managed mutual funds. One important point is, if you consider the active mutual funds, and if you find out how much do they invest in Nifty 50 stocks, about 60% of the total AUM in all active mutual funds, focus funds, flexi cap fund, large and mid cap, small cap, mid cap, everything, 60% was from Nifty 50 stocks in October 2022. So when you say that the market is moving, the Nifty 50 is moving or Sensex is moving, uh, if the mutual funds are responsible partly for that movement, then the active mutual funds have a big play in big say in how much these Nifty 50 is moving up out of the total mutual fund contribution, because they themselves, the active mutual funds themselves, invest in Nifty 50 stocks for several reasons. For example, a small cap fund may invest in HDFC Bank or Reliance stock because it's more easy, basically cash. It's very easy to sell. There will be no liquidity issues. Of course, this is based on October 2022 data. Things may be a little different. Also, we must understand that an index fund is not available in all categories. For example, we don't have an aggressive hybrid index fund, although most of the actively managed aggressive hybrid funds fail to beat a simple index, aggressive hybrid index. We don't have an aggressive hybrid index fund. Unless the AMC offers it, we can't invest in it. Similarly, for balanced hybrid, balanced advantage, conservative hybrid, and so on. So we are still at the mercy of the AMCs. We must understand that. So I would like to stop here. So this will be the first part. In the next part, I'll talk about two types of indices, two ways of investing in indices, and then we'll talk about what index to choose and so on.